Hello and welcome back to our channel. Today, we are doing a deep dive into the first half 2025 financial results for one of Singapore's flagship real estate investment trusts, CapitaLand Integrated Commercial Trust, CICT. The trust has released a comprehensive set of documents, and we've gone through them to bring you the key insights. This will be a detailed analysis, so grab a coffee and let's get started. Before we begin, the necessary disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. All information is sourced from CICT's public filings. Please do your own research and consult a professional before making any investment decisions. Let's start with the headline numbers that matter most to unit holders. For the first 6 months ended June 30th, 2025, CICT has reported a distribution per unit, DPU, of 5.62 cents. This represents a healthy 3.5% increase year-on-year. Unit holders on record as of August 13th can expect this distribution to be paid out on September 18th, 2025. This higher DPU was driven by a significant 12.4% growth in distributable income, which rose to 411.9 million Singapore dollars. The trust attributes this strong performance primarily to the income contribution from the recently acquired Ion Orchard, better performance from its existing properties, and lower interest expenses. Now let's look closer at the top-line figures. Gross revenue for the first half actually saw a slight dip of 0.5%, coming in at $787.6 million. Net property income, NPI, also decreased marginally by 0.4% to $579.9 million. So why the slight dip despite a higher distributable income? The report is clear on this. The decrease is primarily due to two factors. First, the absence of income from 21 Collier Quay, which was divested in November 2024. And second, the ongoing Asset Enhancement Initiative, or AEI, at the Galileo property in Germany. Crucially, if we exclude these two factors for a true like-for-like comparison, CICT's gross revenue and NPI would have increased by 1.4% and 1.7% respectively. This shows the underlying portfolio remains strong. The financial health of a REIT is built on the performance of its properties. Let's unpack the engine of CICT's portfolio. Overall, portfolio occupancy remains extremely robust at 96.3%. This is a testament to the quality and location of their assets. Breaking it down, the retail portfolio is the star performer, with 98.6% occupancy, while the office portfolio stands firm at 94.6%. The portfolio isn't just full, it's also stable. The weighted average lease expiration, WALE, is a healthy 3.2 years, providing good income visibility. Digging deeper into the portfolio, we see its immense scale. In Singapore alone, key assets include retail giants like Bugis Junction and Tampines Mall, and iconic office towers like Asia Square Tower 2 and Capita Green. The integrated developments, Raffles City and Funan, continue to be major contributors. Internationally, the portfolio includes 3 properties in Sydney, Australia, and 2 in Frankfurt, Germany, including the main airport center and Galileo, which we mentioned earlier. This geographic diversification helps to mitigate country-specific risks. A key strength highlighted in the report is tenant diversification. No single tenant accounts for more than 4.8% of the gross rental income. The top 10 tenants, which include reputable names like RC Hotels, GIC, and Temasek Holdings, contribute just under 17% of the total income. This lack of concentration is a significant defensive characteristic. Furthermore, leasing activity remains healthy. In the second quarter alone, the trust signed new and renewed leases for nearly 300,000 square feet of retail space and over 14,000 square feet of office space. Rent reversion for the Singapore portfolio also remains positive, with retail leases achieving a strong 7.7% uplift and office leases seeing a 4.8% increase. Now for one of the most exciting parts of the story: value creation through asset enhancement initiatives. CICT is not sitting still. It is actively upgrading its assets. Two major projects are about to commence in the fourth quarter of 2025. First, Lot 1 Shoppers Mall will undergo an enhancement costing $37 million, creating 15,000 square feet of new retail space with a target return on investment (ROI) of over 7%. Second, Tampines Mall will see a $24 million rejuvenation of its main entrance and tenant mix with a target ROI of around 7%. Both malls will remain open during the phased works, which are expected to complete in 2026 and 2027. These projects follow the successful completion of the AEI at the IMM building and the near completion of the Galileo Tower in Frankfurt, which will soon be handed over to its anchor tenant, the European Central Bank. On top of enhancements, CICT also demonstrates smart capital recycling. On May 30th, the Trust completed the divestment of the serviced residence component of Capital Spring. This strategic sale unlocked $126 million for CICT, which was immediately used to pare down debt and strengthen their balance sheet. This brings us to capital management, the foundation of a REIT stability. CICT maintains a very disciplined approach. Aggregate leverage stands at a manageable 37.9%, comfortably below the regulatory limit. The average cost of debt is 3.4%, and importantly, 81% of their total borrowings are on fixed interest rates. This provides significant protection against interest rate volatility. The debt maturity profile is deliberately well staggered, with no single year having a refinancing cliff. This prudent management is reflected in their strong credit ratings of A3 from Moody's and A- from S&P. Finally, let's look at the broader market outlook discussed in the report. For Singapore, which constitutes 90% of the portfolio, the economy is performing well. GDP growth for 2025 is forecast to be between 0 and 2%. The Urban Redevelopment Authority reports a high island-wide retail occupancy rate of 92.9%, and with limited new supply in the pipeline, retail rents are expected to remain resilient. Similarly, the core CBD office market saw vacancy rates tighten, with CBRE revising its rental forecast upwards. Limited new office supply over the next few years should continue to support rental growth. In conclusion, our deep dive into CICT's first half 2025 results reveals a REIT that is firing on multiple cylinders. The Trust has delivered a commendable growth in DPU, supported by a resilient core portfolio and strategic acquisitions. Its proactive approach to asset enhancement promises future growth, while its disciplined capital management provides a stable foundation. While macroeconomic uncertainties remain a factor for any investment, CICT's scale, diversification, and proven management strategy position it well to navigate the road ahead. That's all for our detailed analysis today. What are your thoughts on CICT's latest earnings and its strategy? Let us know in the comments below. If you found this deep dive valuable, please like this video, subscribe to our channel, and hit that notification bell so you don't miss our next report. Thank you for watching, and we'll see you in the next video.